Things have changed, folks. I now give Alibaba finally the blessing. It's finally a buy again. After years and years and years where this was a no-touch situation, it is finally a buy again. There's no question about Alibaba's financial statements, right? They're phenomenal. The valuation is extremely attractive, all those sorts of things, like steal deal.
Alibaba, watch your back. PDD is coming for the throne. Rest in peace, Charlie Munger. Do you know Charlie still held Baba stock before he died at 99 years old? A quote from Charlie: "Knowing what you don't know is more useful than being brilliant." Why Charlie Munger still has faith in Alibaba until his last day? We are going to find out today. What investor don't know about Baba is that, are the competitions going to take their lunch money? PDD Holdings is one of the most mentioned companies in the US. Across all new items in the last 12 hours, shares in PDD Holdings soared 18% after it reported quarterly results that were far ahead of Wall Street's expectations. And the rival of both Alibaba and Amazon revealed staggering growth. With earnings up 35% and revenue 94% higher in the third quarter from a year ago, PDD is seeing growth at a rate of which any other player in online retail would be jealous. PDD, as a Chinese e-commerce company, is traded on NASDAQ. Currently trades at one-year high of $139 a share. With a market cap of $185 billion US dollars, that's only $10 billion less than the valuation of Alibaba. PDD is clearly a huge reason why Baba stock underperforms, not just because of US-China relationship that Wall Street avoids Chinese stock. PDD Holdings is a social e-commerce platform that encourages users to enjoy lower prices by teaming up to make purchases. Easier sharing of PDD deals with social contacts through Tencent's social network lead to lower traffic acquisition costs versus peers. The firm focused on low-tier cities and white-label merchants, followed by the 10 billion Chinese yuan program launched in 2019 to subsidize consumers for higher-priced products such as moat, Apple iPhones, and agricultural products. PDD aims to offer good value across a wide range of categories and price points to increase average revenue per user, or ARPU. PDD uses subsidies to induce consumers to make purchases in categories they haven't purchased in before. PDD's active buyers in the year ended March were 882 million, likely higher than that of Alibaba. Though we estimated spending per active user was 37% of Alibaba. CEO Chen Li expressed his goal in March 2021 to continue subsidies so as to replace Alibaba as the shopping platform of choice for 1 billion consumers in China. Watch out, Alibaba, you have a target at your back now. PDD differentiates itself through a higher mix of high-frequency categories like agricultural, produce, and groceries. PDD aims to improve farming efficiency and scale, develop a network to deliver perishable agricultural products nationwide, facilitating direct sales between farmers and consumers, and to provide training to farmers to operate online businesses, and so on. Narrow moat PDD Holdings' primary moat source is a network effect. In our view, the network effect is powerful enough to protect PDD from competition for the next 10 years. We believe PDD falls short of a wide moat rating. However, As we think wide moat, Alibaba will continue to monetize the network effect better than PDD in the long term. Our fair value estimate for PDD is USD 117. The stock price is way above that, and with a PE over 30, we think it's overvalued. Compared to Alibaba's massive war chest of cash of 81 billion, PDD has 32 billion of cash on their balance sheet with almost the same valuation. That's why we are buying more Alibaba instead. Alibaba is a big data-centric conglomerate with transaction data from its marketplaces and logistics businesses, allowing it to move into omni-channel retail, cloud computing, media and entertainment, and online to offline services. We think the scraping of the spin-off plan may be because a change of CEO for the cloud unit leads to a review of future strategy. A possible concern could be that the cloud unit requires consistent and sizable investment to stay ahead of the game, and a spin-off unit may see more difficulty in financing as a more independent company. We think there will be more clarity as to the cloud corporate strategy direction when the cloud unit CEO is finalized. We think a strong network effect allows leading e-commerce players to extend into other growth revenues, and nowhere is that more evident than with Alibaba. Alibaba's internet services had annual active consumers of over 1 billion as of March 2022, versus the 1.2 billion online population in June 2022 per Quest Mobile, and the 1.4 billion population in China. This provides Alibaba with an unparalleled source of data that it can use to help merchants and consumer brands develop personalized mobile marketing and content strategies to expand their target audiences, increase clicking through rates and physical store transactions, and bolster return on investment. Alibaba's marketplace monetization rates have reduced recently due to increased compliance of antitrust laws, more competition, and weak consumer sentiment. Gross merchandise volume per annual active user was 8,833 Chinese yuan for the year ended March 2022 for Alibaba, higher than 3,285 Chinese yuan in 2021 for Pinduoduo, and 5,905 Chinese yuan in 2021 for JD.com. While we view the Taobao, Tmall marketplaces as Alibaba's core cash flow drivers, we also believe Ali Cloud and globalization offer long-term potential, while Ali Cloud will remain in investment mode in the medium term. Accelerating revenue per user suggests a migration to value-added content delivery. On globalization, third-party merchants are successfully reaching Lazada's users across Southeast Asia, something that should continue as the company rolls out incremental, personalized mobile marketing and content opportunities. Bullish points. Gross merchandise volume per annual active user was 8,833 Chinese yuan for the year ended March 2022 for Alibaba, higher than 3,285 Chinese yuan in 2021 for Pinduoduo, and 5,905 Chinese yuan in 2021 for JD.com. Core annual active users on Alibaba's Chinese retail marketplaces had a retention rate of over 90% for the year ended September 2021. Alibaba's Chinese commerce adjusted EBITDA margin was 32.5%, higher than JD Retail's 3.1% non-GAAP EBIT margin and PDD's 12.4% non-GAAP EBIT margin for the 12 months ended December 2021. Despite increasing competition, we're maintaining our wide economic moat rating based on Alibaba's strong network effect, where the value of the platform to consumers increases with a greater number of sellers and vice versa. Alibaba is monetizing its network effect better than any other e-commerce platform in China. None of its new competitors, mainly third-party e-commerce platforms Pinduoduo and short video platforms Douyin and Kaoshu, have proved they can monetize the physical goods e-commerce market with a durable profit margin, but Alibaba has been profitable for a decade, and we believe it will remain profitable for the next 20 years. In addition, we think that the live streaming e-commerce that Kaoshu and Douyin offer is a supplement to e-commerce offerings, not a replacement of the mainstream e-commerce platforms. Live streaming e-commerce tends to satisfy impulsive purchase instead of planned or urgent purchases. The return and refund ratio of live streaming is high, which we think is inherent in its impulse purchase nature. This makes it difficult for brands to rely on this channel solely in the long term. Even if these new competitors are successful in generating long-term durable profit, we still see Alibaba's position in the e-commerce market as being irreplaceable due to its consumer mindshare, vastest range of stock-keeping units, logistics infrastructure, operational expertise, governance of products and merchants, protection of consumers, and tools for merchants to manage full product life cycles. It is the largest e-commerce platform that provides to its merchants predictability in sales and production volume, which leads to predictable production costs. Alibaba has reported over 90% retention for its core annual active consumers who are 25 to 45 years old and contributed 70% of gross merchandise volume for the year ended September of 2021. Despite the competition, core annual active users on Alibaba's China retail marketplaces had a retention rate of over 90% for the year ended September 2021. In the year ended June 30th, 2022, there were over 123 million annual active consumers, each of which spent over 10,000 Chinese yuan on Taobao and Tmall. This represents a retention rate of approximately 98% versus the prior 12-month period, similar with the data as of March 2022. Alibaba is the pioneer in new retail and has solutions for diversifying consumption scenarios like on-demand delivery, online to offline, offline and content e-commerce. We think Alibaba will always have its place in China's increasingly complex retail market. So why is Alibaba stock keep falling? Market is irrational because Alibaba stock is owned mostly by retail investors, and they tend to sell when the stock is going down. The chart of Baba suggests the trend is down. Baba is in a downward channel. It's just tested the $75 a share channel base today and bounced off so far. If 75 doesn't hold, we are looking at 70, then 60. But don't hold your breath on it. I think you are getting deep value on your dollar at a PE of under 10 for a business that has double-digit revenue growth. Right now, the stock is pricing in the most bearish of bearish outcomes, imminent China-Taiwan situation, and new CEO could have a huge risk and management impotency. But all of these are just wall of worries. Charlie Munger knows value investing, working with Buffett for his whole career. With a free cash flow yield of 13%, Alibaba's business is significant underpriced. Sooner or later, it will reflect in the share price. I will see you when that day comes.
Somebody like an Alibaba that's really the face of Chinese stocks. So when I look at this, and the valuation's on the floor for the stock. It's a joke, right? I mean, under 8 times next year's numbers, and this is a growth company. Like that's silly.